Hello, everybody. Welcome to day 2 of Credit Week. Financial Services Answer to Glastonbury Festival. The two events actually very similar. 3 days of boozing, headline acts, and a couple of fillers to prop up the agenda. Speaking of which, my name is Carl Richards. I'm a sales director here at Equifax. I'm joined by our amazing affordability director, Andrea. Together, we're going to be delving deep into the world of consumer affordability. For anybody here now in the audience with FOMO that they're missing out on a headline act elsewhere, rest assured, I was joking about Andrea and I being fillers. We are indeed the main event. In fact, we're often referred to as the Elton John and Kiki D of Credit Week. Aren't we, Andrea?
You might be. I'm a bit young, Carl. Anyway, so what we're going to talk about today is we're going to split into sort of 4 areas, really. So I'm going to give a bit of a how did we get here, a bit of a roadmap of what's happened to affordability and where we are today. So a bit of a history lesson. So also then, how are people coping? What can we see about how people are managing through the affordability journey? Is it sustainable? Can that carry on? Who knows? But we'll try and answer that question. And finally, how can Equifax help? So this is the history lesson. Thanks, Carl. So I don't know if many of you are aware, but actually, Cato data sharing started way back in the early 2000s. So there was a government report that came out that basically said they were very concerned about the rising levels of over-indebtedness in the UK. So a few banks got together, worked with a CRA, and provided them with current account turnover data. Now, I still believe that current account turnover data is unique to the UK. The level of data that gets provided on a monthly basis, as far as I'm aware, doesn't happen anywhere else in the world. So we're quite unique. Okay. So that came with a lot of rules, a lot of changes that happened, and a lot of products created. Okay, the big change, which was a shift from over-indebtedness to affordability, really came in 2018, and our favourite part of the Conk Handbook 5.2a. If you're not familiar with it, you should be, so get reading, it's not very interesting. But that really dictates for lenders what we have to do, what you have to do from an affordability point of view to ensure that you're lending to people that can afford it. Okay? Since then, wow, disaster after disaster, economic crisis after economic crisis. COVID came along, we all enjoyed that, didn't we? And then the cost of living crisis. So what I'm trying to say is that things are continuously evolving from an affordability point of view. There's never anything that's standing still. And we have to evolve our products and services and our data along with those challenges. So Carl, can you give us any information, any insight into how the most recent challenges have impacted people's affordability?
Certainly can. I'm glad you asked. So we saw, heading into 2024, a sharp increase in the number of new mortgage repayments. So 58% of consumers are now paying more for their mortgage than they were doing at 2022. And as everybody knows, the interest rates have been skyrocketing over the last few years. To put it into context, what that means from a customer affordability perspective, imagine being on a tracker mortgage in 2022. Back at the start of 22, you could snag a 1.5% interest rate. Fast forward to the end of 2024, that's near 6%. That's, for a consumer borrowing, £250,000 over a 20-year period. That's an increase of £400 per month, about £5,000 per year, which is a good fortnight.
A holiday.
It's a holiday. It's a fortnight abroad somewhere lovely, or a weekend in Centre Parks. The prices of the cost of borrowing from a mortgage perspective is also in line with increased costs of buying a house. So house prices are going up, the cost to get a mortgage is going up. So as a result, we've seen a huge decrease in the amount of mortgage originations, down 24%. What are people doing to sort of spread this extra load? Well, they're turning to other forms of credit, namely credit card debt. And last year we saw that exceeding £70 billion for the first time, an astonishing number. So with all this extra cost going on, we want to have a look in terms of consumer arrears rates, just to understand what might be going on. So here's a graph displaying the relative change year on year from a 1 plus down perspective. So consumers rolling into a 1 plus arrears state. So the baseline is 2022, before some of the interest rates started to rise. And you can see here, relatively, mortgages especially had a huge increase in arrears relative to the year before. That represents a shift from 1.2% to 1.6% arrears. Remarkably, as we move into 2024, and I know it's hard to see the graph because I know these subtitles will be terrible for me, but they're covering 2024. That's last year. The stabilization in arrears was quite remarkable, actually, which begs the question, Andrea, how are arrears rates stabilizing when the cost of our services are going up? Is there anything in the data that might help us better understand that?
Well, it's funny you should ask, Carl, being a data company. Let's have a look what our bureau data tells us. So as Carl's already said, we've already looked at the mortgages. So let's have a look at mortgages. People's average mortgage has gone up by 38%, which equates to about £229 a month. Personally, my mortgage went up by way higher than that, more around £400. So I've had to learn how to budget, especially working at Equifax. 11% of so how are people coping with that? What are they doing? They're having to budget. They're having to change the way that they spend. Okay, so we've actually seen there has been help through the mortgage charter. So these numbers are as of the end of 2024, and at that point we've seen that 148,000 people took up the option to change their mortgage to interest only, to give them a bit of relief whilst they sorted out their household budget. Okay, we've also seen that 11% of new mortgages in 2024 were of extended terms. By that I mean 35 years plus. Okay, so that's helping new people get on the property ladder, so, and also enabling people to spread their payments. The problem with that is that actually older customers aren't able to do that. Okay, so we're actually seeing the highest number of arrears in our 55-year plus group. So that's mortgages, unsecured. Let's have a look at what we can see in the bureau around credit cards. Okay, so you've already mentioned, Carl, that credit card debt is now in excess of £70 billion. That's about the cost of Jeff Bezos' wedding. So the outstanding credit card debt is at 4.5%, above pre-pandemic levels. Okay, so we would expect it to grow. We'd expect it to grow in line with inflation. But the worrying thing here on this graph is showing that actually that debt is growing faster than people's monthly incomings. So that means that there may be a problem to come.
Yep.
Is there anything, Carl, in our open banking or transactional data that actually gives a little bit more insight into how consumers have been coping?
Oh. No. Of course there is. Of course there is. When we look at buy now, pay later, it's obviously a trend that's been going on for a few years now. Consumers are loving it. They're buying more, leaning more into this as a viable line of credit. And I think everybody would agree buy now, pay later is a good thing for the industry. One thing, key thing to note, though, is that at £66 per typical agreement, whilst relatively small in the grand scheme of things against something like a mortgage repayment, it is more excessive than perhaps a typical telco agreement might be from a repayment perspective. And until buy now, pay later becomes regulated and this data is provided to the CRAs, it's a missing piece of the puzzle, a bit of exposure that might be the difference between a good or a bad outcome from a consumer perspective. To this day, open banking is the only way that you can regularly and with assurance get this level of data. Now, consumers are using buy now, pay later for good and potentially quite concerning reasons. The good side of buy now, pay later is for the fashion enthusiast that likes to buy multiple sizes, styles, try them on, send them back, and not be charged or incurring a cost for that. We all know about that. Not that I do it, but the bad side of it on buy now, pay later is called the cost of living crutch. And this is where consumers are actually turning towards things like buy now, pay later to keep up with everyday essentials, things like groceries, which essentially turns them into debt obligations. And that can quickly spiral out of control. And in fact, the UK Citizens Advice Bureau have reported an increased number of consumers that are struggling financially because of spiraling buy now, pay later debts. More holistically, consumers are becoming more cost conscious. So 75% of consumers have changed their shopping habits due to the cost of living crisis. And we can see this in the data. So when we look at shopping with budget-friendly vendors, and we're including things like supermarkets, where people buy their clothes, etc., we can see this trend from the bank transaction data going from January 2022 all the way to October 2024. So people are making changes to their lifestyle and their habits. This is one of my favorite slides. Secondhand clothing. I assume there's a number of people in the room that rely on apps like Vinted to get their clothes. We've seen a huge popularity of this app over the last few years, rising from about 3% in January 2023 up to now 7%. So to think that a second-hand clothing provider accounts for 7% of the full UK spend on fashion is a change in behavior that I don't think we've witnessed before. At the bottom, you can see that people are typically selling more than they're buying. I don't think that's a universal rule. My wife uses Vinted way too much. Not a day goes by where I'm not interrupted by the postman delivering some Vinted parcels. It got so out of hand, I had to give him a key for the house so he could let himself in. Andrea, you look like somebody that wears second-hand clothes. Do you use Vinted?
No, I don't. No, I do actually, but I don't use it for buying. I use it for selling. And look, I've found some really interesting merch that you'll be able to find on Vinted in the next couple of days. I think my mic's gone. Sorry. So that's Vinted. Food expenditure analysis. So we're seeing, as well as people making smarter choices when it comes to consumer spending on everyday things like clothing, consumers are also switching where they might shop for groceries. So as you see from the data here, versus a Q1 baseline of 2022, market share has increased across Aldi and Lidl, with some of the other supermarkets starting to get a little less. Marks and Spencer's has booked that trend, demonstrating that obviously consumers still appreciate quality and convenience. Andrea, have you changed where you buy your groceries? No. You won't catch me shopping at Aldi or Lidl.
Right, okay, right. You could
Come on, Carl. I work at Equifax. Of course I have to shop at Aldi and Lidl. Well, but yeah. It's got great fruit and veg.
Very good fruit and veg.
Yeah. Can you hear me?
Yes, yeah. So I buy my groceries from Ocado, not actually on this list. I do that for two reasons. One, I hate supermarkets and interacting with the general public. And two, I like the stats that they provide towards Christmas time around shopping habits. So, fun fact, during COVID, I was Yorkshire's #1 procurer of soy sauce. Right, so we've had a look at affordability, specifically what's going on with the mortgage market, how consumers are changing behaviors to adapt to that. Now we're going to look a bit forward, horizon scanning, and Andrea's going to cover some of the insights that we might need to be aware of on future changes.
Thanks, Carl. So I don't have a crystal ball. I can't look into the future. I am no economist, as everyone who's ever worked with me will know. But these are the key, as you saw on the very first slide, there's a lot of things, external influences that impact affordability and our affordability assessment. So I'm just going to cover a couple of things that have recently happened. We've not necessarily seen any impact of that yet, but it's something to look out for. And what's important is that we look out for these, we're continually monitoring people's affordability, and we're taking these things into consideration. So firstly, there was a national insurance and living minimum wage rise on the 1st of April. Great news for everybody, particularly low income people. It means they're getting more money in their pocket. But are they really? Because there are some unintended consequences to that. So employers might have to increase the cost of goods and services, so we're all paying more. And also, that increased wage growth might impact vacancies that are available, so will impact the job market. Okay, so we have to keep an eye on that and see where that takes us. Secondly, the increase in household bills. So the change in energy caps, as we noticed, it went down yesterday, just in time for the heat wave. We've got rising water bills, and transport costs are always changing as well. So ultimately, all of this reduces our disposable income and has an impact on our spending. Changing the housing market, we've touched on this. There's expiring fixed rate mortgages still, so people are still getting into that point where the mortgage is costing more money per month. The stamp duty rises, so that's having an impact on first-time buyers. Perhaps they can't now afford to buy that house and they're having to wait a bit longer. And there's also a renters' rights bill coming in. And what this ultimately means is that people might be renting for longer, so we've got to keep an eye on rental prices and rental terms, but also impacts, the mortgage sector is changing quite rapidly, right? There's a lot of new offers out there, 100% mortgages, going back to the good old days, but we have to keep an eye on what impact this is having on individuals. And then finally, we can't get away from it. Global conflict and trade disruptions. So we know that, even at Glastonbury, there was a lot of political stuff going on about the global conflicts. My daughter came home from school last week and asked me if World War III was about to start. So there's a lot of disruption. There's a lot of trade disruption, and this unsettles the global markets, which in turn can raise the price of our goods and services. So all of these things, although we don't really know the impact of them at the moment, like I say, really make sure that we know, keep an eye on them and monitor them going forward.
So next, thank you, Andrea. We just covered some of the evolving factors that might impact affordability assessments going forward. Now we're going to just delve into two key points of reference from a data perspective. The first being buy now, pay later, and it as a lending form becoming regulated next year. So by mid-2026, we anticipate that all buy now, pay later lenders will have an obligation to share that data and insight with credit reference agencies. That's great in terms of identifying that exposure that a consumer is carrying across these types of products. But what it will mean is when you think about buy now, pay later as a credit commitment, the cycle is much more frequent than a typical insight or credit commitment would be. So those are typically reported on a monthly basis. Buy now, pay later is obviously a more instant form of credit. And so from a lender perspective, understanding and working how those types of data can feed into your affordability assessments will be a key change in dynamic that will